As of May 2022, the S&P 500 officially fell into bear market territory, falling 20% from its previous high. In this video, I want to talk about bear market option strategies and things to keep in mind when trading options in a declining market. The first strategy I want to talk about is actually the bullish strategy of selling cash secured puts. I love this strategy in a bear market because it allows you to get paid while waiting to buy shares of a stock that you love at a lower price. And you're also taking advantage of the higher market volatility, which means you'll be selling more expensive options as compared to a lower volatility market. And since the put options specifically are going to be really juicy, then you're going to be collecting a lot of premium and potentially making a lot of money while waiting to buy shares of a stock at a lower price. Let's quickly cover how this strategy works and then talk about its benefits in a bear market environment. So when you sell a put option or short a put option, you are obligated to purchase 100 shares of stock if the put option is in the money at the time of expiration, which means the stock price is below the put's strike price at the time of expiration. So a cash secured put is when you're shorting put options, but you're setting aside 100% of the purchase value of the shares so that you can actually buy those 100 shares of stock at the put strike price in the event that you do get assigned, which in a declining market is likely. For example, a bullish block investor, which is the ticker symbol SQ, they might short a 50 strike put in block and collect $310 into their account. And since the strike price is $50, to buy 100 shares of a stock at $50 a share, that would cost $5,000. But since we collected $310 into our account for selling this put option, we only need to set aside $4,690 to fully cash secure this short put position. So in this particular example, the stock price is currently around $64 and the investor is potentially going to purchase 100 shares of stock at that put strike price of $50. So if the stock price remains above $50 and at the time of expiration in August of 2022, if block is above $50 a share, then this cash secured put trader will keep the whole $310 that they received, and then they will be able to sell another put option in the subsequent expiration cycle to collect more premium and continue waiting to purchase 100 shares of stock at their new put strike price. The big benefit of selling cash secured puts in a bear market is that when markets are declining, typically volatility is high or increasing, and this impacts option prices because option prices are a direct result or a function of market volatility. So if market volatility is high, then option prices will also be high to account for those bigger swings in stock prices. And furthermore, in a declining market, there's going to be a lot of demand for put options because traders or investors can buy put options to hedge against or profit from decreases in stock prices. And that's going to further push up put valuations. And as a cash secured put trader, you are selling these put options, so you are selling those expensive put options as compared to selling cheaper put options in a lower volatility market. You'll also have a high probability of making money since the stock price has to decline pretty decently before you get into that territory of being assigned on that short put contract. And that really is the worst case scenario when selling cash secured puts, is that you end up buying 100 shares of a company that you actually love and want to hold long term, but you purchase those shares at a much more favorable price compared to if you just purchase 100 shares at the time of selling that cash secured put. So back in that block example, the stock price was at 64 and we were selling the 50 strike put. So compared to buying 100 shares of stock at $64 a share, by shorting that 50 strike put, we can actually collect $300 in premium. And if we do get assigned on that put, then we will be buying shares at $50 a share as opposed to $64 a share. The downside of cash secured puts is that you'll need a lot of money to set aside, and to estimate how much money you'll need, simply multiply the put strike price by 100. So in the block example, the put strike price was 50, so we needed to set aside about $5,000 to buy those 100 shares. But if you're trading a higher price stock and, for example, the put strike price is 150, then you'll need about $15,000 set aside to potentially purchase those 100 shares of stock at $150 per share. So if you're keen on selling juicy put option premium and getting paid to wait to buy shares of stock that you love at a lower price, then cash secured puts allow you to do that. So let's switch gears and talk about a strategy that allows traders to profit from continued stock price declines. Now, the cleanest way to do this with options is to buy put options, which is a low risk, high reward trade. Buying put options has a huge advantage over shorting stock because when you short stock, you have unlimited loss exposure to the upside because there's no limit to how high a stock's price can go. And when you're short stock, you lose money for every dollar that the stock appreciates. When you buy put options, you can only lose the amount that you pay for the put option. So it doesn't matter if the stock price increases $100 or $1 million. If you buy a put option, the most amount of money that you can lose is the premium that you pay for it, which makes it much safer than shorting 100 shares of stock. Buying put options in a declining market is super advantageous because buying puts can see an explosion in their values because in a declining market, put options have two forces working in their favor. The first is that if the stock price is decreasing, put option prices increase because the stock price is getting closer to that strike price or moving through it, which means it has a higher likelihood of being really valuable at the time of expiration. The second force is that as markets decline, volatility typically increases, which means the option prices will be expanding as market volatility increases. So if you're buying put options and the stock market really takes a dive, then you're going to be making money not only from the stock price falling, but also from the explosion in volatility that accompanies stock price declines. But there are some downsides to be aware of as well. Bear market means high volatility and a lot of demand for put options because traders and investors can buy put options to hedge their stock portfolios or simply speculate on prices declining. So for that reason, put options will be really expensive as compared to buying puts in a lower market volatility environment. Buying put options in a more volatile market environment means that you'll be paying more for those put options, and that means you'll have more exposure to time decay or how much that option price will lose with each passing day if all things are held constant. You will also lose money if implied volatility falls, which typically happens as the market begins to recover. So you can get hit with a triple whammy here when buying put options in a bear market. If you buy put options in a bear market and the market starts to recover, then you will lose from the stock prices increasing because put contracts lose value as the stock price increases. You will lose money from the passage of time because that stock price movement has to take some amount of time. And you will also lose money from the decrease in implied volatility that typically occurs as markets recover. So if you buy put options and the market starts ripping higher, then unfortunately that put options value could deflate really, really quickly, and that is not good for you. But the benefit, as I described earlier, is that you can only lose what you pay for the put option, which is different from shorting stocks because when you short stocks, you have unlimited loss potential to the upside. The long-term historical average of the VIX is around 20, and currently the VIX is somewhere around 30. So it is above the long-term historical average, but it's not insanely higher than the historical average because in 2020, we saw the VIX above 50 for a period of time. Rarely does it get to that level, but I just wanted to point out that right now the VIX is around 30, which is about 10 points higher than that long-term historical average. So you will be paying a higher premium for all options, but they're not insanely high at this point. And if the market continues going lower, then volatility could continue expanding higher, say from 30 to 40. Which would benefit your long put position. Now I want to talk about some things to expect when trading bear markets, and the first thing I want to bring up is to prepare for the bear market rallies. So when a bear market hits, the market doesn't just go down in a straight line unless we're looking at something like March of 2020, which is pretty much straight down. In most cases, we'll have severe declines and then you'll have pretty significant upside moves as well. So definitely prepare for some vicious rallies in a bear market. First of all, on the decline, you can take that opportunity to take profits on bearish positions. And then on those bear market rallies, you can take that as an opportunity to reload into some more bearish trades. So I've been trading some put options in QQQ very recently, and I've been implementing this strategy. So on June 7th, I purchased a bunch of out of the money put options in the Qs. and then I sold 50% of the position on June 16th for a 80% gain, raising $7,000 in cash. And then on June 24th, we were seeing one of those bear market rallies that I've been talking about, and I took that as an opportunity to reload the $7,000 in cash that I had raised from taking profits off of the first trade, and I reallocated that money into more bearish trades because I am anticipating more downside in the coming months. So definitely take advantage of these bear market declines as a profit-taking opportunity, but then take advantage of the bear market rallies as a place to potentially reload on your bearish positions. So this next tip is a really random one, and it's something I thought of, but I wanted to include, and this is for covered call traders. So as a covered call trader, you have 100 shares of stock and you have a short call. In a declining market, one adjustment that covered call traders can make to their position is rolling down the short call option, which means buying back the original short call and then shorting a new call option at a lower strike price. So that is rolling down. The problem with this in a declining market is that you can get into a situation where you can't sell a call option at a strike price that is at or above your share purchase price for a decent premium. And so some covered call traders might look to sell a call that is actually below their share purchase price. And I would avoid doing this, because what you're doing when you do that is you're essentially agreeing to sell your shares at a loss compared to your share purchase price. So if you buy 100 shares of stock at $100 and the stock price falls to 90, and then you short the 95 call option, what you're doing is you are agreeing to sell your shares at $95 per share if the market recovers. And since you bought those shares for $100 a share, you're effectively agreeing to sell those shares at a $5 loss. Now, of course, you do collect premium for selling those call options, so you wouldn't be taking a real $5 loss, but still the concept is that if you short a call option at a strike price lower than your share purchase price, you will effectively be agreeing to sell your shares at a loss, and I don't think that's a good move. So as a covered call investor, you should be comfortable holding those shares long term because you do hold those 100 shares and you are selling calls against them. So if you can't sell a call option at or above your share purchase price, then I would consider waiting it out, waiting for the market to recover until you can once again start selling call options at a higher price than your share purchase price. The last tip I want to give you is to prepare for the end of the bear market, because at some point the bear market will end and we will start a new bull market. When that is, we don't know. It could be right after I publish this video. It could be 12 months from now. The point is, at some point the bear market will end, so it is good to consider preparing for the bull market, especially if we've been in a bear market for quite some time. If you are anticipating the bear market to come to an end, then consider adding some bullish trades such as buying long call leaps, which means you would be buying call options in a long-term expiration cycle, namely over a year. A long call leap position is a way to get upside leverage on the stock without a margin call potential. So if you're buying stocks on margin, which means you are effectively borrowing money from your broker to buy shares of stock that you wouldn't be able to afford otherwise, or if you are doing something like buying futures contracts, then you have margin call potential because those are highly leveraged positions, and as they start to move against you, the losses can become greater than your actual account value. And that means at some point the broker will liquidate those positions. So those are examples of leveraged upside positions with margin call potential. I really like the idea of buying long call leaps because you get upside leverage on the stock price, but you have no margin call potential because the worst case scenario is that you lose whatever you paid for that call option. You also have a lot of time to be right compared to buying shorter term call options. Now, for that increased time to be right, you are going to be paying a premium for those options, but you can still make a really good return on a very small stock price movement, at least a much larger return than the share price will do itself. For example, let's look at the 500 strike January 2024 call in SPY. If we look at this option price, we can see that the option price generally follows SPY, but the S&P 500 call expiring in Jan 2024 sometimes doubled in value. Like from October 2021 to January 2022, going from less than $20 per contract to over $40 per contract. Now, even a small rally, such as in May and June of 2022, those small rallies generated almost 100% returns on the 500 strike call. And this is even though the stock price never got above that called strike price of $500. So use this strategy cautiously, but understand that buying long call leaps is a way to get leveraged upside exposure to stock price movements, and you have no margin call potential. And for that reason, I think it's a smart way to use leverage with options. So there we have it. That's my list of trading strategies and things to consider when trading options in a bear market. My name is Chris Butler. Thank you for watching, and I will see you in the next one.